Was a buy the rumor, sell the fact. And now you've got gold traders spooked by all the tough talk coming out of the Fed. So the fact that gold is not 5,500 is a lot less significant than the fact that it's at 4,000. And silver has positioned itself for another huge bull market, even if it's, had a correction. I don't think the dollar has a floor. The dollar could lose all of its value, in which case gold and silver prices would be infinite. Eventually, this short-term negative correlation that we've seen between gold and oil is going to break down. And I do think that eventually, if oil prices really start to move up, gold prices will move up along with oil.
China building more and more gold reserves. There's all kinds of speculation about how much gold China really owns. Some say up to 30,000 tons.
China is a major producer. They're a major creditor. They're the largest manufacturers. We're also going to have higher interest rates, higher inflation, higher interest rates, more expensive commodities. And we could see recession and bear markets in stocks. Every time they hike rates, they do make it more difficult.
And now let's talk about gold, your favorite topic. We've had nearly, I think, $900 billion wiped out from gold and silver in just the last 36 hours. Gold is down 2.4%, raising roughly 680 billion. Silver down roughly 5.5%, which is wiping another 190 billion. And then in this whole context, we still have a war in the Middle East. We have inflation fears and market uncertainty rising. So how is gold behaving and what are the mechanics behind, and how do you see this?
Yeah, well, you can't look at the loss of value of gold and silver without appreciating the big gain that preceded that loss. Even though gold is down again today, we're still above $4,000 an ounce. So up until a few months ago, that was a very high price. So the fact that gold is not 5,500, I think is a lot less significant than the fact that it's at 4,000. And the same thing with silver. Silver, yes, it's not 120, which is where it got, but it's 57 and change. So it broke out. I mean, for years and years, silver was trading around $20, and maybe it can get up to 30 and it would come down. So all of that overhead resistance has now been cleared out. And silver has positioned itself for another huge bull market, even if it's, had a correction in the first breakout of that bull market. And I think right now, I think investors were a bit disappointed in the way gold reacted to the war.
A $900 billion wipeout grabs headlines, but the market quietly ignored that gold still sits far above its former breakout zone. Peter Schiff notes investors are focusing on the correction while overlooking the structural reset already achieved. Institutions care more about long-term price floors than emotional pullbacks. Patient investors should ask whether this volatility is distribution or accumulation. Next, Peter Schiff reveals why the Fed's inflation narrative clashes with gold's underlying resilience.
Again, ignoring the fact that gold went up before the war started, and part of that rally may have been the anticipation of the war. And so it was a buy the rumor, sell the fact. And now you've got gold traders spooked by all the tough talk coming out of the Fed and about how now there's a new sheriff in town and he's going to be real tough on inflation, unlike his predecessors. That's all BS. That's just this talk. He's trying to buy some cheap credibility on inflation by just talking about how tough he's going to be. But, even when he was asked in the Senate in the hearings the other week, what are you going to do about high inflation? How are you going to bring it down? He had 3 policies, and they all amounted to talking about it and doing nothing, because the Fed can't do anything but talk, and the markets will figure this out. And so gold prices are going to hit new record highs, if not this year, next year, and the same with silver probably. So I would just be buying the pullbacks.
And how do you see this as major factors that will contribute to this way up? And let's say, what would be your price target personally with a certain date in mind?
Well, I don't really have a target, because I don't think that gold or silver have ceilings. because I don't think the dollar has a floor. The dollar could lose all of its value, in which case gold and silver prices would be infinite when you priced them in something that was completely worthless.
The Fed's toughest speeches often arrive when confidence needs protecting most, not when policy truly changes. According to Peter Schiff, rhetoric cannot substitute for credible inflation control if structural deficits remain unresolved. Markets eventually judge actions instead of carefully crafted press conferences, and that shift can reprice hard assets quickly. Investors relying solely on official guidance risk reacting after institutions already reposition. Next, Peter Schiff exposes the hidden contradiction between dollar confidence and long-term precious metals demand.
But I just have a price target of higher. I think that you'll need more and more dollars to buy the same quantity of gold or silver. And so to the extent that you don't want to spend or invest your dollars today, you want to save to potentially invest or spend in the future, you should not hold dollars. You should hold gold or silver instead of dollars. And the same likely applies to a lot of other fiat currencies, like, you're in Europe. So, I would prefer gold and silver to the euro.
Obviously. And now let's talk a bit more also about miners, because miners have also been, I would say, affected by all of that. And there's something in the equation that also increases the cost of output, and this is obviously energy. So how do you think that this, and this is a question from our audience, how do you think that this energy supply choke will affect the mining sector?
Well, I don't think it's going to have that big an impact. I mean, sure, energy prices are a major cost for the mining stocks. But, the mining stocks didn't get that much of a benefit from the big drop in oil prices relative to gold prices. So I think the fact that oil's backed up a bit is not going to be the primary driver. I think earnings of the gold mining companies are going to continue to be very strong. They're going to continue to beat estimates and grow. And I think the stocks are undervalued, even if the earnings are less.
Holding depreciating currency becomes riskier when purchasing power erodes faster than most portfolios adjust. What Peter Schiff is highlighting is that mining profitability depends far more on sustained metal prices than temporary swings in energy costs. Wall Street often obsesses over quarterly expenses while overlooking expanding cash flows from stronger bullion markets. Long-term investors should watch margins, not headline volatility. Next, Peter Schiff unravels why rising oil may ultimately reinforce, not weaken, the gold bull market.
Than what they're likely to be if they end up spending more on energy. And I do think that eventually this short-term negative correlation that we've seen between gold and oil is going to break down. And I do think that eventually, if oil prices really start to move up, gold prices will move up along with oil, not down.
So you think that the ratio would actually be intact and both would move accordingly in the same direction?
Yeah, despite the way they've traded recently, I think the long-term trend would be that oil and gold move up together. Well, first of all, the main reason I talk about Bitcoin is because Bitcoin is being marketed to people who might otherwise buy gold. Bitcoin is being sold as digital alternative to gold, but superior to gold. So I'm going to push back against that because I am an advocate that people should buy gold. And to the extent that they're being conned into buying Bitcoin instead, that's running counter to what I'm trying to accomplish. So I see Bitcoin as a threat to people who might otherwise have bought gold, but end up buying Bitcoin instead. So I want to try to minimize that happening.
And this is also like one of the topics that's been emerging now, especially last week's about, for example, China building more and more gold reserves. There's all kinds of speculation about how much gold China really owns, and there's different commentators that have different versions of it. Some say up to 30,000 tons, and they are trying to prepare for what you just described now. But
retail investors are arguing over Bitcoin while central banks continue accumulating physical gold. Peter Schiff's argument suggests the real competition isn't between assets alone, but between narratives competing for investor trust. Institutional reserve managers still prioritize strategic diversification over fashionable stories. Protecting wealth requires following sovereign balance sheets more closely than social media sentiment. Next, Peter Schiff reveals why China's gold strategy could reshape confidence in today's reserve currency system.
By at least linking gold to their own currencies, in this case, the yuan for China.
I think China probably has a lot more gold than they let on, and they probably want to buy a lot more gold than they let on. And they're doing that for a reason. They understand that the dollar's days are numbered, and they want to position themselves to basically take that position. They want to have the dominant economy. They want to have the dominant currency. And the way to do that is to have the most gold, to have a currency that's backed by something, because that would be a viable alternative to the dollar, because the dollar is backed by nothing. So if, the dollar used to be defined as a weight of gold. Now it's just, paper. But our economy doesn't support the dollar's valuation because of our lack of productivity. But China's does. China has all the savings and production that we used to have.
And in this new, let's say, impulse of what China is doing in terms of building an infrastructure around gold, and we're talking about SGE vaults now that are in Shanghai, in Saudi Arabia, and others, maybe planned in Switzerland and other countries, of the convertibility between gold and yuan, and perhaps even commodities. We've seen also with in Iran, like the talk of like having Saudi oil paid in gold yuan. Do you see this as a viable infrastructure then to build and rebuild, let's say, the rails of international trade?
Sure, around China. I mean, look, China is a key factor. I mean, they're a major producer. They're a major creditor. They're the second largest creditor nation in the world behind Germany. They'll soon be the number one creditor nation. They're the largest manufacturers. So the Chinese economy is going to dominate, the 21st century. I mean, America dominated the 20th century, but we won't dominate the 21st.
Major monetary transitions begin long before headlines admit the old system is weakening. This is where Peter Schiff's thesis shifts from metal prices toward the architecture of global trade itself. If settlement mechanisms increasingly incorporate gold-backed credibility, reserve preferences may evolve gradually rather than suddenly. Investors ignoring geopolitical monetary infrastructure could miss the bigger structural trend. Next, Peter Schiff exposes why reserve accumulation matters more than official currency announcements.
And you just said also that you see oil going much higher. How much higher, and what would be the main catalyst, a part of the obvious situation that we see in the Gulf with the war in Iran? What's your full analysis around that?
Well, I think demand for energy is going to continue to rise, not just because of AI, but just, for other factors in the economy. But I think the real catalyst would be if we get a breakdown in the U.S. dollar, which we haven't had yet. It's something I've been expecting, but it's something that hasn't happened. But I think when the U.S. dollar really starts to fall, and I'm talking about versus other fiat currencies, not, in terms of gold, where the dollar has already broken down, although it's bounced from its lows earlier this year. But I think gold now has a lot of support around 4,000 and is getting ready for another big rally. But when the dollar really starts to fall against other fiat currencies, that's really going to be a catalyst for a much bigger rise in the dollar price of oil. Because as the dollar starts to fall, if oil prices stay the same, that amounts to a decline in oil prices for everybody else. But I think the world will respond to lower prices by buying more, and that will push up the price in dollars.
And what about then other commodities? Because we've just talked about oil, but there's all kinds of other commodities that are impacted about the choke point in supply. Do you also believe that, Jim, and I talked about this a few days ago, that this will be the onset of a global economic slowdown?
Commodity markets often react to currency weakness before policymakers publicly acknowledge the underlying shift. Peter Schiff notes a declining dollar could amplify oil prices even without dramatic supply disruptions. That creates a feedback loop where inflation pressures persist despite optimistic official messaging. savers exposed only to cash risk, absorbing purchasing power losses they never anticipated. Next, Peter Schiff reveals why commodities may outperform even during slowing global growth.
With a huge rise in inflation that we haven't seen since the 70s, a resurgence of the previous wave we just witnessed a few years ago.
Yeah, I mean, I do believe that, global stagflation, particularly, maybe in the developed, the Western economies, is going to be what defines the next several years. I think we've underinvested in capacity for all sorts of raw materials, and I think commodity prices are going to be headed a lot higher, along with overall inflation, based on all the money that's been created by the central banks, especially since COVID, but even going back to the days prior than COVID. But before COVID, after COVID, rather, they kicked it into a higher gear. So we have a lot of inflationary forces that have been built in that are going to be, rearing their head, and as well as increased demand and inadequate supply in a lot of commodities. So that's a recipe for much, much higher prices. We're also going to have higher interest rates. Higher inflation, higher interest rates, more expensive commodities, and we could see recession and bear markets in stocks.
And that's actually a good segue to then what I've seen lately, saying that there's a big likeliness that the Fed will hike interest rates with 25 basis points by tomorrow. That those odds have risen above 35% for the first time after the inflation data that data release. Do you believe this is really likely?
Well, I don't think they're going to hike rates. I guess it is a coin toss, but I think that they're still going to err on the side of staying pat.
Economic slowdowns don't automatically eliminate inflation when supply constraints keep tightening underneath the surface. According to Peter Schiff, persistent monetary expansion and underinvestment create conditions that resemble stagflation more than ordinary recession. That combination challenges traditional stock and bond diversification strategies many retirees depend upon. Portfolio resilience increasingly depends on owning assets with tangible scarcity. Next, Peter Schiff unravels why rate expectations may matter less than the Fed's political timing.
I think they have at least something to justify it based on. There's been some numbers that they can hide behind that might suggest that inflation may have slowed a bit or the economy is weakening a bit. But I think they're also likely to hide behind these task forces that they created to study the problems and come up with solutions. And so they may be saying, look, we're waiting to get the results and the recommendations from the task forces. So that might, if they don't move in this meeting, I think the odds that they move the next meeting are even lower, because now we're getting a lot closer to the election. And they don't want to take the chance of spooking the markets when the election's around the corner. So I think if the Fed is going to hike rates before the elections, they got to do it tomorrow. But I agree, if they do it, it's not going to be a big move. And I think, moving up by 25 basis points does nothing to change the dynamic. So if the Fed thinks rates are too low, a quarter-point rate hike's not going to do anything about it.
Well, it's a bit of a tit for tat as well in terms of the bond market and the fact that they aren't able to also really finance all those interest rates on the debt, right? I mean, the next 12 months, around $8 trillion of treasuries need to be rolled. The average coupon is around 3.3%. The 2 years around 4.3%. So that's a huge debt load, and just an interest payment alone as well. The question is, can they even hike rates?
Well, yeah, every time they hike rates, they do make it more difficult.
Election calendars often shape monetary expectations more than official inflation forecasts ever admit. What Peter Schiff is highlighting is that even modest rate increases barely address structural debt pressures while increasing financing costs. Markets frequently celebrate symbolic moves that leave the underlying imbalance untouched. Investors should separate policy theater from genuine monetary tightening. Next, Peter Schiff reveals the debt arithmetic that quietly limits future Federal Reserve decisions.
For the U.S. government, which has been rolling over more and more of their debt short term, so they're not even, borrowing for 10 years or 30 years. They're borrowing, for a year or less. But yes, it's going to make it more expensive if they just want to, borrow for 90 days. They're going to pay higher rates. And it's already happening. I mean, if you look at the net interest expense or annualized in June of the U.S. government, we spent $1.6 trillion on interest. That was the entire federal budget as late as like 1997. And now we're spending that much money just on interest, right? Forgetting about everything else.
But how much more do you think that they can raise interest? I mean, there must be a limit.
Well, there's obviously a limit to how much the market can bear, but rates should be a lot higher given how much debt we have and how much inflation we're gonna have. So rates are still much too low. They should be a lot higher. The problem is we can't afford to pay the rates that are as high as they need to be. That's why the Fed has been artificially suppressing them. But that has other adverse consequences that you're seeing with the rise of the cost of living, which is being pushed up, and other misallocations of resources that result from the artificial suppression of interest rates.
A government spending over $1.6 trillion annually on interest has less flexibility than headlines suggest. Peter Schiff's argument suggests markets aren't mispricing inflation as much as policymakers are suppressing its consequences through financial engineering. The longer rates remain below economic reality, the greater the pressure on savers and currency credibility. Wealth preservation increasingly depends on recognizing those incentives early.